Welcome to the World of DaaS, a show for data enthusiasts. I'm your host, Auren Hoffman, CEO of SafeGraph and GP of Flex Capital. For more conversations, videos, and transcripts, visit safegraph.com/podcasts. Hello, fellow data nerds. My guest today is David Sachs. David is co-founder and partner at Craft Ventures, one of the foremost SaaS VCs. He's also the former COO of PayPal and the co-founder and CEO of Yammer, which he sold to Microsoft for $1.2 billion. He's an investor in over 20 unicorns, including Airbnb, Facebook, Palantir, Uber, and SpaceX. On top of that, he's found time to co-host one of the most popular tech podcasts in the world. David, welcome to World of DaaS.
Good to be here. Thanks, Auren.
Now, these tech layoffs can create these kind of seat contractions, which then yields to more layoffs, which is a really bad spiral. How do you see the current time in SaaS playing out?
Yeah, I mean, I've pointed out that vicious cycle. We saw that, I think it was in Q3, Salesforce, which is the bellwether of SaaS. It's one of the best run SaaS companies. They reported a 2/3 reduction in net new ARR for the quarter. So that was a real signal about what's happening in SaaS. We're seeing a slowdown across the board. I kind of predicted at that time that you would see layoffs on the heels of that, because if your net new ARR goes down by 2/3, but you're still spending the same amount of money on sales and marketing, it wrecks your unit economics. So for example,
your LTVs go down dramatically, essentially.
Yeah, well, it's just you're spending the same amount of money to get 1/3 as many customers. So your CAC, your customer acquisition cost, is basically triples. And you saw that their CAC payback, which is the amount of time it takes to earn back the acquisition cost in a customer, went from somewhere in the 2 to 3 year range to like 12 years.
Wow.
So it became pretty clear that they were going to have to make adjustments in their sales and marketing spend. Otherwise, again, their unit economics would be wrecked. And so then, you saw a few weeks ago, they did, I think it was like a layoff of like 7,000 people. So I think you're seeing that across the board. Every company's kind of dealing with that. But the downstream effect of that is that if you think about all of Salesforce's vendors now, they're going to be spending less money with them. I mean, for one thing, when Salesforce buys software from other companies, there's just 7,000 fewer seats.
Yep.
So like you mentioned, you have this phenomenon of seat contraction. And for the last decade or so, a huge tailwind at the back of software companies has been seat expansion, meaning that, on January 1st, the beginning of every year, you'd typically start with 120% of last year's revenue just from your existing customers, because those customers were growing and buying more seats from you. And I think now we're in a period where the number of seats is either going to freeze or go down. And so you could be in a world in which, instead of starting with 120% of last year's number, you start with 80 or 90% of last year's number. And then on top of that, new demand is going down because companies are just getting much more conservative about what they're spending money on. They're sharpening their pencils. So you're seeing a reduction in new customers. And then the third negative thing that's happening right now is I think you're going to see elevated logo churn over the next couple of years, that more and more companies are going to go out of business because it's a much tougher fundraising environment. So you add those three things together, which is slowdown in new business, seat contraction, and then logo churn. And I think we're in for a pretty tough, year or two for SaaS companies. And that's why I've been really urging them to tighten their belts and get ahead of this and be much more conservative in their planning. Don't go into the year planning to spend, with a burn multiple of 2, which is basically, I mean, the burn multiple is a metric I've come up with which basically describes the multiple of spending or burn to the net new ARR you intend to generate. So, a lot of companies are going into the year with 2, but that means that if they miss on new ARR or their churn is higher, the burn multiple is 3, 4 or higher. I've urged them to get really lean, go in with a plan with a burn multiple of more like that. If you miss, you still have some cushion. So in any event, I think it's going to be a tough time.
And partially this is because a lot of these SaaS companies, venture-funded SaaS companies, were selling to technology companies, even a lot of other venture-funded SaaS companies. So you have this kind of like pernicious cycle that's happening.
Yeah, how does
it ultimately play out then? Like, how do you think, like, is it just like 2023, we're in for a very, very tough year, and then maybe kind of starts to work itself out in 2024?
Yeah, I think we're probably out of it by mid 24 is sort of the base case. I think it's sort of like a 1 to 2 year reset, and then things start growing again. But yeah, I think, if you're a SaaS company, you really just want to prioritize survival during this period. Trying to, I mean, growth is always nice, don't get me wrong, but I would rather be a little more conservative on growth and guarantee survival than trying to, juice growth an extra whatever, 10, 20, 30%, but risk the fate of your company. Um, think about it this way. It's sort of like, instead of having tailwinds, you've got very strong headwinds over the next couple of years. And if you try to maintain your speed with intense headwinds, think about it like a plane, you're going to burn an incredible amount of fuel. Or you can just accept the fact that you're going into intense headwinds. You're just slow down your speed, accept the lower speed, and just burn a lot less fuel and conserve. And then, because look, the demand does not exist in the market anyway. So when we come out of this period and we start having tailwinds again instead of headwinds, then you pour on the gas and you can start to fly faster.
Some of these, a lot of these companies, these SaaS companies raised in maybe 2021, a lot of them are sitting on a lot of cash. If they do have low burns, do you think there will be opportunities for them in 2023 or early 2024 to make very accretive acquisitions or other things they can be doing with this cash?
Definitely. But, what I've seen is that they're not sitting on it, they're spending it.
Yeah.
One of the problems is that that the free availability of capital, people are able to, companies are able to raise these huge rounds at really high valuations during the bubble, which is 2021, especially the second half of 21. And they raise that money from players who largely don't exist in the ecosystem anymore. I mean, you had these huge crossover funds who are basically public market investors who thought they were getting an arbitrage by going earlier into the private markets because they were
Like
seeing the
the
huge,
Tiger Global
like
type of.
Tiger was like the main one. Yeah. I mean, Tiger did maybe half the growth rounds that were happening in 2021, and they were doing it at, yeah. I mean, they were doing it. I mean, that was the experience in our portfolio. And they were doing these rounds very quickly. You just send them your numbers and they would give you an answer within a day or two. And the valuations they were paying were like 2x what everyone else was paying. If you got like a term sheet from Tiger, it was literally double what kind of what the next sort of traditional growth fund would do.
You
And
have
this,
to give a board seat even usually.
yeah, exactly. The terms were very favorable. Um, and yeah, and so and by the way, they were paying double market at that time, and market was really high. So in any event, the point is just not to bash on them. I mean, they were taking their cues from the public markets, right? I mean, they were looking at the public markets for valuing high growth SaaS companies, which means a company growing, say, 40% year over year. They were valuing them at 30, 35 times ARR. So they were looking at the private markets and saying, here's a company growing 3x year over year. Why wouldn't I pay 100 times for that? Because in 1 year, they'll be at 35 times.
Yep.
And then the next year they'll be at 10 times, and I'm going to make a huge arbitrage. And so they were taking their cues from the public markets, and the public market was taking its cues from the Fed, which was engaged in like a 10-year period of like zero interest rates. So everyone was kind of thrown off by this. And now that same high growth SaaS company might be trading at 8 times, something like that. Like, literally a 75% reduction in the multiple.
And what
But in any event, we kind of got off on a tangent here. I think the point is just that these conditions don't exist anymore. And the founders they got trained on those conditions, they thought that capital would always be this available, huge amounts of it at high valuations, and it's not. But they got addicted to that, and they started spending as if that capital is available. They developed this habit of going out and raising around every year or 18 months. And so they thought that all this money they raised, they could just, burn over the next 18 months and it'd be fine. But those companies are in for a rude awakening, because if they can raise it all, it's going to be at like a valuation that might be 80% lower, or multiples that are 80% lower. So yeah, I hope they're preserving cash the way that you're saying, but I'm not seeing as much of that as there should be.
No, anecdotally, I haven't seen growth slow due to the layoffs. Are you seeing something similar where these companies might be laying off a fairly large percentage of the staff, but still, it's hard to know. It's hard to run the experiment like with and without what would have happened with or without layoffs, but it doesn't seem anecdotally to really affect the company's growth for most of these layoffs.
No, I think you're right. I think these companies got really bloated, and there's a lot of excess and entitlement that grew up in the system during this like zero interest rate period. And I think companies are finding that it doesn't impact their performance at all when they do these headcount reductions. They start to acquire a lot of people they didn't really need. And I mean, the ultimate example of
Sometimes they
this.
could
Mhm.
you could see a scenario where they could even grow faster because, having a lot of people is tough. You need a lot of systems. It's very hard to communicate. It's very hard. So often you can build faster with fewer people. You might be able to do some go-to-market things faster. So it could be a blessing to these companies as well.
Yeah, I mean, they're easier to manage when they're smaller. I mean, another like thing that happened obviously was remote work over the last couple of years, which maybe was a necessity in response to COVID. But I think what people are finding, if they're paying attention, is that there's a huge reduction in productivity when everybody's just working from home and they're all atomized and in different locations, as opposed to everyone being in the office and having a strong culture of being in one place or in a few hubs. And so I think companies are starting to go back to work. And when they do that, they're realizing that, there's a lot of people who are working from home who are basically on permanent vacation or semi, permanent vacation. So there's a lot of things they can do to get more efficient and just discard again a lot of the practices that again grew up in this like very bubbly period that I think weren't they didn't happen because they lead to more productivity. They happened because um there was this intense war for talent fueled by the bubble, and employees got to demand a lot of things that may not be in the interest of the company.
The best companies get leverage over time, kind of with maybe defining that like just the CACs decrease over time. And but a lot of these companies, like the CACs almost get worse over time. How do you know early on in a company like which are the ones to invest in to the ones? How do you know that these are the companies are more likely to get leverage than others?
Well, the thing I'm looking for at an early stage is just whether the company has a differentiated distribution strategy. So, do they have they figured out how they're going to market, and are there channels through which they can go to market and pursue a strategy that's again different from other companies? Because if all you're doing is defaulting to the same channels everyone else is using, like a Google AdWords strategy or something like that, you're just not going to be very cost efficient. So you need to have a way of attacking the market that is not so crowded, basically. And if you have that, you have a way to get started. And I mean, that's what we're looking for in an early stage. There is a question down the road of, when does this channel get saturated? Like maybe it can only lead to so much growth. And then at that point, you need to find some more channels, or your CAC does go up. But in any event, at the earliest stages, it's too hard to know when a particular distribution channel is going to peter out. And really, what you're looking for is just that there's at least one where the company has figured out how to go to market.
When you look at your own investing mistakes, what do you wish you knew 15 years ago?
That November 2021 was going to be the absolute peak of the market. I mean, um, yeah, I mean, we all got lulled into a false sense of security because of zero interest rates. I guess that's the thing that that we sort of forgot about was that these macro conditions do matter, not on the level of any particular investment, but in terms of the asset class as a whole. And if you could have sold everything in November 21, then you clearly would have or distributed everything. We had a sense, like I was saying in around that time, that I thought things were really bubbly, and we were trying to distribute things to LPs, and we did it. I think we did a decent job, but in hindsight, you wish you had taken your advice even more. I think the magnitude of the effect, even though we kind of understood it, was underestimated.
Given where we're at now, is there anything like the Fed can do to help us get to a softer landing, or we just have to play this out over the next kind of 18 months?
Well, yeah, it's interesting. I think that what the market seems to be pricing in right now is that the Fed we got a good inflation report last week. So the last inflation report, right on expectations, and it shows that inflation is going down, which is the Fed's objective. And the reason inflation is going down is because the economy is worsening. So all the performance indicators of the economy are they're looking pretty bad. I think we are headed for a recession. I think we'll be in recession by the middle of the year. And the question is just what the Fed's going to do now. And if I were just to guess, I think it'll be one or two more quarter point increases. So as opposed to 75 basis point increases,
Yep.
I think they're gonna peak at 5% or 5.5% or higher. I could be wrong about that, but
Do you
the
see
best
that
chance
just
for us.
happening like in kind of Q1, Q2, 2023, and then even by the end of 2023, they start tapering it a bit? And because you assume the Fed's a political body, like there's going to be a lot of pressure going into 2024 to lower interest rates.
Yeah, I think that's right. I think there'll be immense pressure to not be blamed for causing Biden to lose the election because they created such a severe recession that he was going to lose. Especially if Trump's the Republican nominee. But regardless, I think that my guess is they'll cut again in Q1 of 2024. But it could be as soon as Q4. I guess it depends on how severe the recession is. But I think we're in this period of like being whipsawed between inflation and recession and rate increases and rate decreases. But look, I think the short answer to your question is if the Fed stops raising now, I think we'll get a less severe recession and maybe a soft landing. But I doubt they're going to do that. I think they're going to keep raising, but maybe in a more tepid way.
You've met a lot of super successful people over the time, what do you think are the most common traits of super successful people?
I basically think that in our world, there's two kinds of people. There's basically the creators and then there's the joiners. And I just think it's like two very fundamentally different personality types. The creators are the people who don't quite fit in to other people's structures and feel the need to create their own. And they see, a market opportunity that nobody else has been able to see. It's a more, maybe a more contrarian mindset. And then you've got people who are just fundamentally joiners and they need the structure. If you just give them a blank sheet of paper and tell them go make a living, like they won't know what to do. They need to kind of join an existing organization and blueprint, and they like the certainty and guardrails of having a track and being able to work their way up. Those types of people, because they're hired into a reality instead of creating their own reality, they tend to value things like credentials a lot and resume. Whereas like the more founder personality doesn't really care about resume and credentials, and just those things are kind of irrelevant to that person. So
In
it's,
the environment of like the 2018 to 2021, where there's obviously a lot of status to the creator, do you think a lot of joiners kind of decided that they were creators?
yeah, I think there was, it's, our friend Kevin Hart said that, this is a few years ago, he said that becoming a founder is like the new McKinsey, which is, all these people thought that becoming a founder is the thing they
Yeah,
had to do.
checkbox.
It was the
Yeah.
box they had to check. And the reason that was dangerous is not just because they may not be like perfectly suited to it, but also because in their mind, like failing was sort of acceptable because like the objective was just to be the founder, check that
Yeah.
box. And
YC company or something. Yeah.
yeah, exactly. Go to YC. Yeah. And YC definitely helped a lot with this because it created the track, right?
Yeah.
Being a
Made it
founder.
easier.
Yeah. All of a sudden being a founder was something that became a little more tracked. Now, to some extent, that's good because, in like the late 90s, I wanted to become a founder, but I had no idea how to do it. So I ended up going to law school, which is a big waste of time until Peter Thiel recruited me to PayPal. But so it's helpful to have some, some institutions, but
Yeah.
things did become a little too tracked. And I hated this idea of, get your first failure out of the way or whatever. In my view, like, failure is totally unacceptable. And I mean, now look, we have a culture of forgiving failure, and that's good. I mean, one of the reasons why you get more risk taking and entrepreneurial activity in the US as opposed to, say, a place like Europe is that, failure is not something that's hung around your neck forever. You don't go to, like, debtor's jail or whatever. But I think that's healthy for society as a whole. But I think in terms of the individual psychology of a founder, I think you should have, like, a burn the boats mentality, and be very determined that you're going to be successful, because creating a company is just so hard that if failure is an option for you, then it's just too tempting to take it. um I think one of the common denominators of the whole PayPal mafia is just how, like, phenomenally determined everybody was to make that company a success, no matter how much adversity there was.
Yeah, if you look
So
at the story, it was like
yeah.
failure, 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 and that's right,
There were a lot
so,
of pivots, and
yeah.
then, once the right product found product market fit, there were also, like, a ton of obstacles that should have killed the company, but we didn't let it happen. So, but I kind of worry that the super tracked founder who is creating a company as a resume item just doesn't have that psychology.
And what do you over the last 20 years, what do you think, like, tech has what are the commonalities you think are just kind of the same, and what has really changed quite marketably over that time?
Well, I think the thing that's changed is that the whole tech ecosystem has gotten a lot bigger. I mean, you remember in the late '90s, early 2000s, the tech ecosystem was really concentrated around Stanford and the
Yep.
sort of it wasn't even the whole Bay Area. It was really the peninsula, maybe going down to San Jose for hardware. And then it just kept getting bigger and bigger, and so Silicon Valley spilled over and became Silicon Bay. You had it expand to San Francisco, you had it expand to the East Bay, then it expanded to other cities, and so it became more of a national story, and then globally as well. So just the continued growth of tech to being this, like, sort of very local thing to being this national and global thing has just been the inexorable trend over the last 20 years. I think the thing that's still the same is the boom bust cycle, which, the last year has really reminded us of this. We thought that um, the laws of the business cycle had been suspended because it seemed like we had been in a boom market for so long. I mean, really, since the financial crisis in 2008, 2009, it seemed like we've been on this upward trajectory since 2010, and it seemed like the business cycle had been suspended. But now we see that, it's here. And when tech goes through a bust cycle, it's really intense. It is much worse than the rest of the economy. For us, it's an 80% contraction in valuations and, with all the cascading layoffs. Whereas for the rest of the economy, a recession is, negative 2%. So, I think a lot of the lessons that we learned in the dot-com crash are, newly applicable now. And people have forgotten a lot of them.
One of the weird things is in this environment is while most of the industries in the US are very inflationary. If you run a local fast food restaurant, like your labor costs have gone up quite a lot. Your costs of, your ingredients have gone up quite a lot. For tech companies right now, most of their costs are extremely deflationary. Engineer salaries have gone down, especially when you consider like stock compensation. The amount they're spending on software has gone down. If they're acquiring companies, well, that has been severely deflationary. How do you think, like, they should be thinking about that is essentially in a deflationary environment?
Well, I think this is ironically a great time to be building a tech company or to be starting a tech company. If you're a founder who has a great idea and the right mentality, this is a great time to be starting, because you're right, all of your costs are going to be lower. It's a lot easier to recruit. I mean, besides the fact that it's less expensive, it's just easier to recruit. That's usually
Yep.
the big problem. Office space is, like, almost free.
Yep.
Um, And there's just a lot less noise. You're not going to have like 5 other companies doing the exact same thing as you, creating, a lot of confusion in the marketplace. So I think it's a great, recessions are a great time to be building companies, assuming your idea is good enough to get funded, because the one thing that does get harder is fundraising. But if you can manage that, and then operate in a really lean way, it can be a good time to build a company. PayPal was started before the dot-com crash, but it was principally grown after the dot-com crash. My company, Yammer, which we sold to Microsoft in 2012, was founded in 2008, just before the financial crisis, but it was, almost entirely grown in the wake of the financial crisis. So those can be good times to build a company. And I think from an investor standpoint, it's a better time because, again, there's less noise for us to sift through, and the founders are much more serious about it because, the founders who are like super risk averse just won't do it during the year. They're gonna cling to the job security of working at a big company now, which from my standpoint is just fine. I want to work with the founders who, feel compelled to do it, from something deep inside, as opposed to just wanting to do it because
Resume
everyone
check
else
or
is doing
something.
it. Yeah, just because everyone else is doing it, it seems like the good thing to do. So, yeah, I think this is a good time to be building and creating companies. The only reason it's not is because founders can't wrap their head around the legacy issues. So in other words, like, they did that big round in 2021 and they still have that burn rate and they still think they
Yeah.
need all these people, and they just can't adjust to the new reality. And if they just could, then they'd be in great shape, but they can't. So that's, that's the downside. And I think there's so many companies which their cap table is all like screwed up because, they raise money at like a valuation that just can't be justified now. And instead of just like doing a one-time reset to something sensible, and then maybe topping off the employee stock options to compensate them for that, and just getting it over and done with, they're going to try and cling to this old valuation. They're going to end up with like a lot of structure in their cap table and, stuff like that.
Because it's like a human condition to kind of cling to that story. If you were worth, in your head $100 million, you don't want to be now all of a sudden worth 20 or something.
Yeah. I mean, so I'll give you an example. So one of the best companies in our portfolio, I won't say which one, it's a SaaS company that's doing very well and, selling software to enterprises and doing, huge, contract values. They raised, I think the absolute peak of the market is around November of 2021. Um, they had about 12 million of ARR at that time, and they raised around at 100 times ARR. So 1.2 billion. Yeah.
Whoa. Okay.
Yeah. It's big valuation, especially by today's standards. But at the time, that kind of stuff was happening. The company has done really well. I think it's around 30 million of ARR now,
Great.
So the valuation is more like 40 times. The problem is, like, even 40 times in this environment is a lot, like the valuation probably should be somewhere in the 10 to 20 times range.
Yeah.
That is like a lot. That's a lot for a founder to get their head wrapped around, is that you've done everything right. Your company is growing really well. And it's one of the, it's one of the more successful names in our portfolio, but the valuation is still probably, it's probably 2/3 less even now than what you raised at, even though you've tripled. So knowing that, like, if you're the founder, like, what do you do about that? I mean, I tend to think the first thing you should do is just operate super efficiently, because you're just never able to raise capital on like terms that were so great and so lopsided towards founders as they were in November 2021. And so, like, the first thing you should do is just like really conserve that cash.
Yeah.
Think about that cash as if it's coming out of your next round, not the previous round. This is the mistake that founders make is, well, that round was only a 10% dilution round. Yeah, but if you were to raise that round today, it'd be like a 50% dilution round. So think about that cash that way, assuming you
Yeah.
could even raise it, which you might not be able to. So if you think about the cash saving you dilution in the next round, you would treat it much more dearly than, when it was just being given away in 2021.
And I'm sure you have a sense, like, I'm sure certain, companies in your portfolio, they have, less than a year's cash, and some companies in your portfolio have like 5 years of cash or something. And is
Mhm.
there is in your head, do you have like a sense of like, this is the minimum number of months you should have in the bank right now? Or
Yeah, I mean, I want them to have 2 years in the bank at least from now. But we were saying this, we told our portfolio companies that we started doing briefings with our portfolio companies. We did one in February of last year, and we did another one in May. And the message was the same, which is there's been a regime change in the capital markets. I think everyone now knows this, but we're
yeah,
trying to get the message to them earlier. And yeah, I want them to have at least 2 years of runway. I think that's what's necessary to get through this recession. The problem is that there's a couple of mistakes I think that they make in terms of runway. So one is just the way they calculate runway. I have a very simple way of calculating, which is I take the amount of cash you have in the bank and divide the most current month's burn, and
yep,
that tells me how much
very
runway you
simple.
have. And
Yeah,
and what I see is like these overly elaborate ways of calculating runway, which depend on forecasts. Well, we're going to be generating all this incremental revenue over the next year, and so
right,
therefore
right,
that's going to be an offset to the burn. And the problem with basing runway on a forecast like that is that that revenue might not materialize.
yeah,
And so what's going to happen is you're hit with a double whammy of missing your numbers and running out of money at the same time. And so you're unable to raise because you missed your numbers. And then you don't have an accurate, picture of your runway. And those companies are the ones that just hit a wall and die. So I like to have a very simple conservative way of measuring runway. The other thing that I think the other mistake that companies make with respect to the runway is they think that they don't need to fundraise until they're out of runway, and that's just not true.
yeah. In this environment,
So
it could be a year before they have to start, right?
yeah, so if you have 2 years of runway, that's not 2 years to operate your business and improve your metrics until you have to fundraise. It might be 1 year. It might be more like 5 quarters. And the way I do this is the way to explain this concept to founders is you work backwards from the cash out date, you know, which is I've been on boards before that have 3 months of cash left, and I can tell you
It's not
that
fun.
well, basically at that point you're in wind down mode. I
Yep.
mean, you like what happens when you have 3 months of cash left is the lawyers all of a sudden come in, they tell you about all these liabilities that you didn't know you had.
You got to pay your employees,
You
and
gotta
yeah,
pay your employees or whatever, like, and some of these statutes have, like, personal liability to the directors, and everybody's just like, "How do we wrap this up elegantly without creating liability?" So, you're, like, dead at 3 months. So then 6 months is really your last chance to raise, where people are not in wind down mode, and the problem with raising at 6 months before cash out is that, if you can do it at all, your back's against the wall, and you're probably gonna get
you
really
you have
terrible
to take
terms.
whatever you take.
You
Yeah.
take whatever you get, you're not gonna be happy with it. So then you raise 9 months before. And really, I would recommend a year before because if something goes wrong with the process, at least you have 1 or 2 quarters to like revise your business and then raise again. So really, you're looking to raise 9 to 12 months before your cash out date, which if you've got 2 years of money in the bank means you're fundraising a year from now, which if what I'm telling you is correct, we're like still in the midst of a recession. So, yeah, not good. I mean, you really need more cash than you think you do.
Now, a couple policy questions. This you've been somewhat critical of these very, very large internet companies, Apple, Google, Amazon, Microsoft, and the power that they have, and kind of they're essentially these like Uber regulators in tech. Is there anything we can be doing to create a more competitive ecosystem?
Well, yeah, I mean, there seems to be a growing bipartisan consensus that what I've called tech MAGA, like you said,
Yep.
Microsoft, Amazon, Google, and Apple, they're too big and too powerful. I think there's some important differences in how people would approach the regulation, but I tend to think that the area we need to focus on is that the giant tech companies that control hugely powerful platforms, preventing them or limiting their ability to compete with downstream apps is really the key thing that you want the regulation to focus on. Because otherwise, what will happen is over time, they will just keep extracting and siphoning off more and more of the value capture from the downstream apps to the platform. I mean, we saw this dynamic with Microsoft in the 90s when it controlled the desktop operating system. It used that privileged position to gradually dominate every important category of application. And so I think that over time, as our ecosystem, the internet ecosystem, becomes more mature, like, all the value capture is going to go to, it's going to go to the owners of the iOS and Android operating systems, and to a lesser extent, but similar, Amazon will start dominating more and more of these, like, product verticals.
Yep.
Microsoft is a slightly different version of this, where like, this is more of like a bundling issue, where what they'll do is they'll take whatever the hot SaaS app is du jour in that given year. They'll just, like, clone it and throw up, like, a crappy, clone of it into their E5 bundle and give it away for free, thereby pulling the rug out from under that company. But
Yep.
then the next year they'll just raise the price of their bundle. So it's similar. But the point is just, if these companies are allowed to engage in practices like this, they will gradually extract all the value of the ecosystem. And I think, from the point of view of having a healthy ecosystem where you actually get innovation, it's important not to let that happen. Because, like, from the VC standpoint, why would you fund? If all the value captures ultimately go to the platform, why would you fund any of these applications? Um, even in the unlikely event that the startup proves out the value that they're trying to create, great, they'll succeed for a temporary period, and then that value will eventually be extracted by the platform. So I think that's the thing that regulators need to focus on. And unfortunately, like, I think they're, like, kind of confused about this, because um like, Lena Khan, who runs was it the FTC,
Yep.
she came in being, with this reputation of being very tough on big tech, and wanting to look at, being tougher on enforcing competition, but, like, has gone about it in this, like, really weird way. Like, so, for example, like, they're prosecuting, no, they're basically litigating with Facebook, trying to prevent, like, a acquisition of a VR game. I think, like, Facebook's the wrong company to be going after. Like, if
Yeah. They're
anything, the last
certainly
couple,
not nearly as powerful as the other four.
yeah, like, let's go after the $1 trillion club. So they're not in that $1 trillion market cap club. So I just think, like, that's an indication they're not as powerful. And VR is a space that's still so speculative that the market is punishing Facebook for pursuing it. So, like, getting in the way of some very speculative acquisition that may just help them prove out that VR is even a thing.
Yeah.
Like, that's like hampering innovation without, like, that's not, VR is not like a market that needs to be protected from monopolies.
But you mentioned it's
Yeah.
so bipartisan, this regulating tech, but it does seem like when when governments do regulate tech, let's say GDPR, it actually strengthens the hands of these big companies rather than weakens the hands. Like, do you see it playing out in any way where it actually makes things more competitive?
Well, the dynamic you're talking about, regulatory capture, is a problem across every industry, not just tech,
Yes.
which is that when the regulators go in to try and regulate the companies that have the lobbyists and the money to pay the lobbyists and make political contributions, and they have the trade associations or the big established players, and they end up helping to shape the regulation so it benefits them, and it really creates a barrier to entry for the startup that may not even exist yet, and so therefore is not represented in the process. I think it's a huge problem. I don't, it's sort of just a classic problem in public policy. I don't know how you solve it except to be really clear about what you're trying to achieve. And again, I think that what our elected leaders should be laser focused on is just this idea that of anti-competitive practices by platforms trying to extract all the value of the downstream apps. I mean, that's the nature, that's the specific problem that they should be focused on. Um, GDPR, things like that. I mean, there are, like, user privacy issues that
Yeah.
need to be addressed. I don't think it's it's not an antitrust issue. It's more about, like, data protection issues. And I think the key is just to figure out how to make them achieve the objective of privacy without creating like really burdensome regulations. They can tend to be overly heavy-handed, and then that again is much harder for startups to comply with than these big companies that have huge legal departments.
Now, on the foreign policy side, there's the kind of the Warhawk Wing does seem very bipartisan. Even the most progressive members of Congress, which have traditionally been very, very anti-war, have been kind of lining up more on the favor of war. Like, what do you think the phenomena is behind that?
Yeah, it's kind of disappointing. I mean, there is no more, let's call it, anti-war progressive left. You saw this really starkly when the Progressive Caucus recently released a letter to the Biden administration urging them to put diplomacy on a parallel track to funding Ukraine with, virtually unlimited weapons and arms and aid. And they weren't saying don't provide the weapons and the funding, just also have a diplomatic track.
Yeah.
And the reaction to that was so hysterical that every signer of the letter except for one ended up retracting the
And
letter.
why was that reaction so? Because if you think of like if this was before the midterms, if Biden wanted to break with the more progressive wing, there were probably a lot more politically savvy things he could have broken them with that would have helped him on the midterms. This is probably not one that was such a big election issue. So why was it that this was the issue that he really wanted to break with them on?
Well, yeah, I don't know if it was fully driven by the administration. It was also like this media backlash, and the mainstream media has provided a very one-sided view of this war, and they are basically boosters for the super hawkish view of American foreign policy, which the Biden administration is also pursuing. So there's just very little room for dissenting thought on these topics right now. There's a tremendous amount of conformity, and it's way worse even than the Iraq War, which I remember from back in 2003. If you raised any objections or concerns to the Iraq War, you were immediately branded as being unpatriotic or even a traitor. Back in those days, I didn't know better, so I thought I supported the war because I thought the Bush Cheney administration knew what they were talking about. I thought when they said that Saddam had WMD programs, they were telling the truth, and when they said that Saddam had links to Al Qaeda, I thought they were telling the truth. It all turned out to be lies. And they basically lied us into that war, and it ended up being a costly occupation that didn't work. And so since then, I've become much more skeptical of the claims of our foreign policy establishment, the sort of hawkish wing, the sort of neocon wing that's on this crusade to convert every part of the globe into, and meddling in the internal affairs of these countries to convert them into a form of government that they like better. So they're still on that crusade now. I mean, this is a long rabbit hole we can go down. But yeah, I mean, I became sort of skeptical as a result of seeing 20 years of failed interventions in the Middle East. I became much more skeptical of that interventionist foreign policy. And but the conformity of thought around this is even starker today than than it was in 2003 with the Iraq War. Again, you were called unpatriotic then if you questioned the US's invasion of Iraq. Today, you're called a Putin sympathizer, or pro-Putin, or whatever, a Putin apologist, which is another form of saying you're a traitor. If you merely want to put diplomacy on a parallel track here and have this war resolved through some sort of diplomatic settlement. And certainly if you raise any questions about how we got in this war, the role that NATO expansion played, for example, which it played a very significant role.
Yeah.
You're called all these names or whatever. One day we'll be able to talk about this stuff honestly, like we are about Iraq. But while it's going on, it's very hard to have an honest conversation about it.
And if you think of like the kind of expert class, you call them the foreign policy establishment. If you think of the expert class and other things, let's say the Fed or something, they got a lot of things wrong over the last 30 years, but maybe they got a lot of things right. And we can quibble on it. It does seem like more on the foreign policy establishment that most of the big things, maybe all the big things, they got wrong. Why do they remain still so trusted to make these decisions?
Well, um, it's interesting because I think that what happens is that um, the American people just generally are not that focused on foreign policy until you get a foreign policy disaster. So, when you have a war that goes badly, then the American people become pretty focused on it. So
Yep.
Vietnam or even like in Iraq, I think that the failure of the Iraq War, I think it was one of the major issues that allowed Trump to come out of nowhere and win the presidency as a total outsider. It certainly was the issue within the Republican Party that allowed him to shatter the Bush dynasty.
Yeah. And
Remember,
certainly
like
allowed Barack Obama to win in as well.
that's right, yeah, he beat Hillary Clinton for the Democratic nomination on the basis that he had opposed the Iraq War and she had
Right.
voted for it. So when you have a foreign policy disaster like that, then the American people focus on it. But short of that, they're more focused on domestic issues, and so therefore, it's really the conduct of our foreign policy is really up to the foreign policy elite, and the elite consists of a bunch of institutions around Washington that the so-called blob. It's the think tanks and it's the military industrial complex, the big defense contractors who are funding a lot of the think tanks. And there's kind of a revolving door of people who, who work in government and then go to the think tanks and then go to the defense contractors or their boards. And it's a very sort of cloistered, closed circle. The defense contractors are basically the retirement program for the Pentagon. I mean, if you're a general, you work up to how many stars you're going to get, you retire, you end up, joining a bunch of defense contractor boards. So I think this is the military industrial complex that Eisenhower warned us about. And then, I think there's a lot of, there's a strong ideological component to it too. It's not just about it's not just about the financial incentives. If you're somebody who goes to work in in a think tank, you're a neocon or something, your ideology is probably going to be one of foreign intervention because like what motivates you to want to devote your life to it
Want to make the
anyway?
world a better place, and so you want to
Yeah.
intervene, right? I presume, right? You're
Yeah.
more Wilsonian, I would
Yeah,
presume, right?
exactly. Yeah, it's self-selecting. I mean, don't ask a barber if you need a haircut. I mean, or what's the Upton Sinclair line? It's hard to get a person to understand something when their interest, when their salary depends upon not understanding it.
Yep.
So you go into the foreign service, you join the State Department, or you join one of these think tanks. You're like geared towards foreign intervention and developing clients and the whole thing. So yeah,
It's
it all
because there is this credentialism in the foreign policy, which does exist in many other areas, but the maybe like other areas today, it seems like some of the foremost interesting thinkers who are or who at least have been more correct over the last few years, have been people who don't necessarily have these credentials.
Well, they're a different kind of credential. So the school of thought that's been the most correct about American foreign policy over the last, call it 25 years, is the realist school.
Yep.
I mean, just go back and look at it, look at their predictions. So, the kind of the dean of the realist school is Professor John Mearsheimer, University of Chicago professor of international relations. He predicted in the early 2000s that our policy of constructive engagement towards China would be a disaster. It wouldn't work. That instead of making them more like us, we would just make them rich and then they would seek to compete with us. He was right about that. He predicted that the Iraq war would be a fiasco. It would lead to a long, costly occupation, which is what it did instead of, being greeted as liberators. And then he predicted this Ukraine war back in 2015 and gave the foreign policy establishment a roadmap to avoid this war, and that they went in the completely opposite direction. This is one example. So the realist school, if you just look at like track record, which I think we as investors are like inclined to do, it's
Yep.
like, what's your track record? Like the realist schools, they're like the most correct, and the sort of the neocons are the least correct, and then the sort of the liberal interventionists, which they're like, I would describe compared to the realists, for example, there's like minor differences with the neocons. They're almost as incorrect as the neocons. But they're the ones who basically run the foreign policy establishment. And again, I just think it comes back to these institutional incentives, which is, if you're part of the blob, the military industrial complex, the foreign service, the State Department, the think tanks, your incentive is to get involved. It's to do things, not to be skeptical of foreign intervention. And imagine if you're a young aspiring player in this, whether you're an intellectual or you want to join the State Department or something like that. I mean, how do you think you're going to be received when you're the one person in the room saying, guys, like maybe there could be unintended consequences from our meddling,
Yeah.
You're not going to be a team player. So
Yeah.
they're going to root you out. And I think the foreign policy establishment is one of the most, again, cloistered and prone to groupthink establishments that we have in America. And that's really saying something, because there's a lot of groupthink and a lot of sort of elite establishments. That is one of the most. And you look at the way that the realists generally are considered by people inside this establishment. It's like, whoa, it's like this, like deeply illegitimate and not respectable school of thought, even though they've been right about everything.
Now, a couple more questions.
Yeah.
You've commented a lot about cancel culture. Do you think we're at peak cancel culture, or do you think we're kind of just getting started?
Well, there's been a major backlash and reaction to the cancellation tactics. So I tend to think it probably the cancellation tactics probably peaked. I don't think the underlying ideology has changed at all. So you still have this underlying woke ideology which uses these cancellation tactics, and that ideology is not going away. The adherents of it are going to fight to keep it, and in fact, they're systematically taking over every institution that matters, from the very big to the very small to every local school board. Yeah, so I don't think the ideology is going anywhere. I think there's been some amount of backlash to the tactics, and that might temper the use of those tactics, but I'm not super optimistic.
All right. I'm a big fan of the AllIn Podcast, and
Mhm.
I think just keeps getting better over time. Like, why do you think it's been so successful?
I think it's the authenticity of four friends who are having conversations and debates as if they were sitting at a poker table, which was the original concept of the show. And
Yeah.
it's very hard to get that type of kind of honest, amicable debate. I remember when 20 years ago, when I would watch cable news, the sort of fixture of cable news were these debate shows. You'd have
Crossfire or something.
Crossfire, yeah, you have Pat Buchanan versus Michael Kinsley. Or if you want to go back, this is before my time. The original archetype was you'd have William F. Buckley versus Gore Vidal.
Yep.
Or you'd have George Will versus Sam Donaldson. Every show was kind of a debate show, and you don't get that at all anymore. It's every network.
Not only was it a debate show, but you could tell they liked each other, even though they
Mhm.
came from very, very different views. They had respect for one another. George Will and Sam Donaldson, they respected one another, even if they might
Yeah.
have disagreed on most things.
Yeah, I don't think they were buddies. Just if you watch the McLaughlin Group,
Rudolph and William F. Buckley were definitely
yeah,
not buddies.
definitely not, definitely
Yeah.
not. But if you watch McLaughlin Group, I think that Pat Buchanan and Eleanor Clift are not buddies, but I think they respect each other, and
For sure.
it's amicable enough. I saw profiles of Pat Buchanan where Eleanor Clift would defend him as he's not like this. She may be repulsed by his views on certain things, but she defended him as a human being. So yeah, this is a throwback to that, but I'd say even more so because we're all friends. And so there's also just outside of politics, there's also this entertainment value of us, busting chops and, making fun of each other and that kind of thing.
All right, this is great. Last question we ask all of our guests: what conventional wisdom or advice do you think is generally bad advice?
I mean, the one that I've critiqued is the whole do things that don't scale advice. I tend to think
It's
that's
the Paul Graham. Paul Graham
yeah,
writes a lot about it.
yeah. I don't like that one because I think what happens is that the early practices of a startup become a little bit of a template for everything that happens later, and it becomes habitual. Basically, the early practices and the culture that's set early on become a pattern that's very hard to break. And I tend to think that the whole purpose of software companies is to do things that do scale and try to do things in the most elegant, scalable way. So I don't like the idea of like affirmatively trying to do things that don't scale. Now, the example that was always given in support of this philosophy was the way that Airbnb got off the ground. Supposedly,
Yep,
there's this whole like myth about
taking the
that may be
pictures.
true. There's like a
Yep,
founding myth about they went to the Republican Democratic conventions that year and they did the cereal boxes or whatever with Obama
yep.
O's and McCain Crunch or something like that. Um, I personally find it unlikely that that was the reason why they were successful. But even if it's true, what I would say is that I think that marketplaces might be a very narrow exception where you need to somehow generate the initial liquidity on the marketplace, right? So, like, there's a huge chicken and egg problem with marketplaces where if there's no houses for rent in the market, then how's anyone going to rent one? And so, generating the initial supply is something that
Yep.
has to be bootstrapped, and the initial bootstrap
Even
may
there
not.
might be there's a hack often to get a lot of supply on, and if you're Amazon, you just like basically take all the books and put it on. There's other ways to get
Yeah.
the things
Yeah, there
on.
may be like way better, more scalable hacks. I mean, I think like what Uber did to get the initial supply of drivers was just to go to like the town car companies and sign them up. And, you get like 20 or to 30 cars at a time instead of the onesie, twosies. But eventually, once they had the supply, then they opened it up to everyone. Then they
Yep.
got, so I think, if you're a marketplace, yeah, you may have to bootstrap your initial supply in non-scalable ways, but I still think it's better to find scalable ways of doing everything. Um, so yeah, that's one of the things I've critiqued. I think there's, especially in the current environment, I think that people need to take another look at blitz scaling. The idea that everything's just a land grab and you need to grow as quickly as possible to grab it. I mean, that's certainly a philosophy that we practiced at PayPal back in the day. So I understand that philosophy, and I do think it's applicable to new markets where there's a huge network effect, right? And
Where
so,
there's a lot of competition and a lot of especially well-funded competition, right? Who's also going to be doing something similar.
yeah. So, I mean, Reed's thesis that you want to be the first to scale. That's who's going to win. I think there's a lot of support for that, and it makes sense in a lot of cases. However, I think it doesn't make sense in a lot of cases too. Like in SaaS, it's a little different, where um,
Well,
I
blitzscaling almost certainly you need a lot of cash, and
yeah.
so you have to have some sort of a surety that next year you can go raise the money, if you're blitzscaling, I presume, right? And if you don't have
Yeah.
that surety, it's more difficult to do.
Yeah. Yeah, I think that's right. I also think that with SaaS companies in particular, it's so important to prove the unit economics and that the go-to-market models scales. So, for example, like we wouldn't fund a SaaS company. Let's say they were growing really fast, but then you look at their sales metrics and they've hired 10 times more salespeople than they need. And so the CAC doesn't make any sense.
Yeah.
We just wouldn't fund that because we can't know whether the market adoption is a real reflection of product market fit or whether the company is just like pushing its product onto the market, and like the way they make pate where they're like stuffing the goose.
Yeah.
Um, you don't want to, you don't want to invest where there's no market pull because again, you could be buying growth in a way that is uneconomic and therefore not sustainable. And when you do try to rationalize the economics of the business, you all of a sudden find out that there's no demand for it because the whole thing was like astroturf or sort of
And
artificially
in those
generated.
cases, later you'll probably see a lot of churn. So those are probably things that are much more likely to have high churn later on.
Yeah, exactly. So, at least for SaaS businesses, what I'd much rather see is a startup that takes time to get it right and really has their model dialed in. And then, they grow like very predictably from there. They're doing, ideally you do the triple, double, or whatever, but we definitely want to see the growth, but it doesn't need to be 10 times. I think it was different in the days of consumer social networks where there was such an intense network effect that you really wanted to scale first. I would balance that today with, the need to be economically efficient.
Well, this has been great. Well, thank you, David Sachs, for joining us on Roll to DaaS. I follow you at David Sachs on Twitter, and I definitely encourage our listeners to engage with you there. I really appreciate it.
Absolutely. Good to be with you, Auren.